In this video, I'm going to be sharing with you 3 keys on how to maximize your rental income. How to maximize your rental income. Now, of course, if you're going to be maximizing your rental income, it assumes you have a rental property. So whether it's pre-rental property or you already have the rental property, these 3 keys can still help you maximize your rental income. So the first key to maximizing your rental income is to not over leverage. Don't over leverage yourself. How can this help me maximize my rental income? Easily. If you over leverage yourself, that means the purchase price of the property was too high, or the cost of acquisition was too high, and then the cash flow or the return that you're getting on your investment is too low. That means you may very well be over leveraged. And guess what? There are times when the purchase price is good, the cost of acquisition is good, but if you're a creative investor and you bring in private money lenders or other funding partners into the deal, that private money lender or that funding, whether it's a hard money lender, private money lender, or just a silent financial capital partner, it can eat your deal up and cause you to be financially over leveraged on the debt service, not necessarily on the purchase price or the cost of acquisition. So the most important key to maximizing your rental income is when you know you're looking at purchasing a property, acquiring a piece of real estate that you're going to buy and hold for rental purposes, you want to make sure that you're not over leveraged. Okay. You don't want to be over leveraged on the P&P. That would be the purchase price. So that means I want to make sure the price makes sense. Of course, if it is a creative deal like owner financing or subject to, then the purchase price is not as important as the COA or the cost of acquisition. So for example, if the purchase price on a property or the loan balance on a property that you're purchasing creatively is, let's say, $100,000, that's not necessarily the purchase price. It would be the loan balance that remains. We're saying if you're taking over the payments, right? But let's say the cost of acquisition is $80,000. So that means all into this deal, that would be $180,000, which, by the way, I'm giving you a case study of a real property. So I don't use hypotheticals, just for you to know that. Even if I say hypothetical, in my mind, I'm still using case studies that I know have worked. So in this case, the loan balance on this creative deal was $100,000. The cost of acquisition was $180,000. So that means my purchase price was $180,000. So of course I have to know what the after repair value is in the event that I sell it. But in this case, if I'm maximizing my rental income, I want to know how much am I actually paying in terms of the PITI every month. And I'm going to have to put that against what the rent value is going to be to determine how much money I'm going to get after my operating expenses and after my debt service. So again, I've got to make sure if it takes $80,000 to get into this deal, and let's say I bring a private money lender in this deal, that private money lender is going to have to get paid on what I am getting out of that rent, minus the operating expenses, minus the debt service, so that I won't be over leveraged. So let's just say, hypothetically, the rent value is $1,800 and the PITI is $900, and the debt service for the private money lender, let's just say, is $600. So that would be about $1,500 from the $1,800. If I deducted operating expenses and management, I might be breaking even. So of course, if I'm a seasoned investor, and I know I'm kind of going on this tangent, but if I'm a seasoned investor looking for depreciation, it may work for me with little cash flow. But all I'm saying is just the raw data, the raw numbers that you put together in terms of purchasing, whether it's conventional or creative, you don't want to be over leveraged. That means you want to have some wiggle room for cash flow, for capital expenditures, for things that show up that you didn't expect, for potential private money lenders if you're bringing them on deals. So that would be the first key to maximizing your rental income, okay? Key number 2, you want to make sure you have the best exit strategy. Now, what do I mean by that? Well, if you're talking about rental income, doesn't that mean I'm renting it? Doesn't mean you have to rent it the traditional way. So, for example, you can rent a property the traditional way for $1,800, but you can do a lease purchase in a non-traditional way, and it won't be $1,800. It may be $2,100 plus a bigger down payment. So that would be a way to maximize my rental income. Okay. So, for example, if I rent it for $1,800, someone pays me $1,800 for rent, and they pay me $1,800 security deposit. That's $3,600 that I'm getting to rent my property for $1,800 a month. Over here, I could do a lease purchase or a lease option, and I can say, well, I'm going to lease it for $2,100, and maybe that $300 difference is what the lease tenant buyer is paying me extra for in terms of their down payment. So I may have an option fee. If it's a $250,000 house, let's say if I say, okay, the option fee is $25,000, and they don't have $25,000 to put down, but they have 15. Let's just say they have 10. Well, $10,000 as a down payment is way more than $3,600 for a first month rent and a security deposit. And that $10,000 is not a security deposit, it is an option fee. The other 15 could be built into the $1,800 that would have normally been the rent, that could go up to $300 to make up the difference in that option. So that's me maximizing my rental income. I'm still renting it, but I'm renting it with an option that the renter has to buy it at a future date. Okay, so that's why you want to have clarity on what is the best exit strategy. A lot of traditional real estate investors, they just get a property and they say, well, I'm gonna just rent it out. Well, sometimes that's not the best exit strategy, and it's not the way to maximize your rental income. Just in that scenario that I gave you, I'm making $300 more a month, and my down payment was 3 times more. And it's gonna be like, almost 10 times more, at least 7 or 8 times more over the course of a 1 to 2 or 3 year window with those extra payments. So that's why this is the second key to maximizing your rental income. Number 3, third key, make sure that you have efficient systems and processes. What do I mean by efficient? Well, it's exactly what I mean. Make sure you have systems and processes. What type of systems and processes you need? Management systems and processes. Maintenance systems and processes. Utility systems and processes. If you're paying for some of the utilities, maybe the tenant is paying for them in this case, or perhaps let's say you're still paying the insurance, you're still paying the taxes. It may be in your escrow for your PITI, but either way, you still want your systems for management, for maintenance, the financial systems to keep the lease terms on par, meaning that if you put a 12-month lease together, whether it's a regular lease or a lease purchase, okay, when you get to the 10-month window, within that 60-day window, you need to be efficient, or your manager needs to be efficient to make sure that you're getting an extension on that lease. And if in the lease you're going up a couple percent, be efficient. Let's say if it goes up 3% every year, be efficient. I know a lot of landlords who let people stay in places, and it's like you there 10 years and they never go up on the rent. And so the market value is $2,500 a month and they're still paying $1,600 a month. Well, that's not maximizing your rental income. And again, if you're the kind of person that you can't do that to people, that's why you need a property manager. Or maybe you just need to be a private money lender, a silent partner, and let people who are real estate investors that know what they're doing be on the front line. So you want to be efficient. Your financials, you want to make sure your financials are efficient, your profit and loss statements, because when you are building a rental portfolio, you're going to have tax liabilities. You're going to be working on depreciation. You want to make sure that the properties are being taken care of. All of these things are going to require efficient systems and processes. So these are just three. There's so many others, but these are just three of the top keys that I could think about that I would say you would need to utilize in order to maximize your rental income. Don't over leverage. Make sure you have the best exit strategy and be efficient with your systems and processes. Of course, if you need more information, coaching, mentorship, want to join us for some of our real estate investing workshops, learn more about the creative side of real estate investing, because I went on a tangent with that creative, because that's where my sweet spot is. We have courses, we have weekly coaching calls, we have quarterly workshops, we have just a ton of support in our community for people like you who want to get into real estate investing, whether it's fixing and flipping or buying and holding, so that you can maximize your rental income. Put a comment in the comments. Give me some feedback. Let me know what you think about the video. Click the link in the description. Reach out to us if you have any questions. Otherwise, I'll see you in the next video.